Welcome to the Be Smart podcast, how not to be an idiot with your money. We're going to get into a little post payrolls here today, Jared. But first off, how you doing?
I'm super excited right now. You want to know why?
Yes.
Because you're not a DJ, so I don't expect you to know anything about this. But the CDJs, the CD players that you use to DJ with, Pioneer just came out with their latest model today. And I ordered them this morning. So I've been working on CDJs that were like 2 models ago. Like I didn't even get the last ones. So I've had like really out of date equipment for like 6 or 7 years. And I'm finally going to get the new gear. And I am excited. I am really excited about this. So,
nice.
Yeah.
Awesome.
Fired up.
You're going to crank out some tunes?
Yeah. I'm going to be shaking the house this weekend for sure. So,
absolutely.
Yep.
Okay, let's get into these headlines. We got a good amount to go over today. Our first one, weak U.S. payroll gain of 22,000 cements case for Fed rate cut. U.S. job growth cooled notably last month while the unemployment rate rose to the highest since 2021. Non-farm payrolls increased 22,000 in August, and revisions showed employment shrank in June for the first time since 2020. The jobless rate ticked up to 4.3%. Several sectors posted outright declines in August, and job growth was once again concentrated in healthcare. Ex-healthcare, though, total employment has declined in 3 of the last 4 months. Here's a quote for you from Heather Long, chief economist at Navy Federal Credit Union. The labor market is going from frozen to cracking. This is a white-collar and a blue-collar jobs recession. We've got the weakest stretch of job growth since the pandemic, and McIntarfer, aka Mackinfarter, is no longer here to fuel our conspiracies, or Trump's conspiracies, rather. So where does this leave us? If we're talking recessionary, what does this latest data suggest here?
Well, there's actually some new news since you got all that news. So the new news is that today we're recording on September 9th. The last 12 months payroll revision came out, and the BLS said that there are 911,000 fewer jobs than they thought there were over the last 12 months. And last year it was 800 something thousand. So the BLS is like either on the fritz, or their data collection is bad, or the economy is a lot worse than we thought. I've heard some theories about why the labor market has been so weak. One could be because of AI. Like AI actually could be causing job losses at this point. That is possible. Another possibility is the immigration rates, right? Like I don't have the numbers on how many people we've sent back to their home countries. I suspect it's at least in the thousands, maybe more. So maybe that is having an impact, or maybe people have self-deported, right? Which we don't even know about. Like maybe people just, saw the writing on the wall and just went home, So there's a lot of factors impacting employment. The unemployment rate is still 4.3%. It's still pretty low. I still find it kind of odd that we're going to full battle rattle and cutting interest rates when the unemployment rate is 4.3%. I don't think there's cause for panic, but the trend is definitely downwards.
Speaking of rate cuts, I mean, it's pretty much 25 basis points is pretty much priced in, I would say, but there has been some chatter about a 0.5 point cut. Do you think that's a possibility?
I don't. I've heard the chatter. I've seen that getting passed around online. Especially after today, after the revisions came out, the 911,000 jobs. I still don't think it's cause for a 50. I think 25 is pretty much locked in unless we get some drastic piece of information between now and the next meeting.
Stocks after payrolls. I mean, I don't even know what it takes for stocks to really go down, but as I understand, there was a pretty big move in the bond market. What happened there?
Yeah, bonds rallied a lot, which I was a little annoyed because I kind of missed that. And I thought the bonds were cheap and I thought they could rally, and I just wasn't involved. But yeah, bonds have rallied. I mean, I want to say the long bond has gone up 4 points. Yields have gone from about 5% to 4.7. The 2-year note is at 3.4. Rates are a lot lower than they were a couple weeks ago.
And last week you said gold is running like an antelope, and that definitely seems to be the case here. Are you seeing any changes in sentiment now? Are people starting to talk about it a little more?
It's really, you have the gold knuckleheads on Twitter that like chirp about it all the time. But in terms of like broader sentiment, like I just keep saying the same thing over again. Like 2011, when gold got up to 1900, like that was a bubble. Like people were having gold parties in their houses where they'd invite over like a gold dealer and they would sell their gold and get cash and stuff like that. Like we are not there yet. We're not even close. Like that will happen eventually, but I think that's at a level that's much higher than here. So I think from a sentiment standpoint, it's got a long way to go. Like I don't remember the stats, but I think the average portfolio has like 1 or 2% gold in it. Obviously, there are some portfolios like mine which have a lot more gold in it. But even still, like if you think about it, if you take all my gold, silver, gold miners, silver miners put together, that's 40% of my portfolio, right? Which still is not a lot, right? And I'm like supposedly a gold bug. But if I were really a gold bug, it would be 80% of my portfolio, 100% of my portfolio. Like I'm still only at 40%. So, and if the whole world goes from 1% to 2% to 3%, that's a huge amount of inflows. I encourage you to pull up a chart of GDX. GDX has just gone vertical.
I saw it. I looked at it yesterday.
Yeah.
Meme stocks, your favorite stocks. Robinhood and AppLovin stocks soar on news of S&P 500 inclusion. They'll be added to the index at the start of trading on September 22. On Monday, Robinhood closed about 16% higher and AppLovin about 12% higher. I know you're not going to touch these two stocks with a 10-foot pole, but are there any meme or bubble type stocks that you would touch in this environment, potentially from the short side? I mean, I'm not asking for specific tickers here or anything, but is it worth looking at given valuations?
That's such a hard question. I don't really know. I mean, first of all, Robinhood and AppLovin, if with a gun to my head, I would rather buy Robinhood. Like Robinhood is a real business. It's extremely expensive, but they're constantly innovating. They're constantly doing new things. That is, look, if Robinhood were trading at 25 or 30 times, I would actually think about buying it. Like it's actually a good business. AppLovin, I think, is garbage. So meme stocks that I would short. I just think I'm kind of doing that already. Like I have 2 stocks in the Daily Dirt Nap portfolio that I bought puts on that are kind of like meme stock-ish, and that hasn't worked out well. I mean, it hasn't worked out well. Like it's in these situations, if you want to buy something, it's better to be early than to be late. If you want to short something, it's better to be late than to be early.
Mortgage rates, they sunk to an 11-month low. And the question here is, will Fed cuts push them even lower? So with the big drop last Friday, 30-year mortgage rates have fallen to their lowest level since October 2024. And looking at this chart here, it's on Friday, it was about 6.48%. I believe it's even lower now since Monday. The Fed is widely expected to deliver 2 to 3 cuts this year, but mortgage rates don't always move in sync with Fed policy. It's kind of a common assumption that when the Fed cuts rates, mortgage rates fall, but the federal funds rate mainly affects short-term borrowing costs, not long-term loans like mortgages. Is that correct?
Yeah, it's 100% correct. 100%. The curve steepened a little bit. It went from 2s10s, went from like 50 to 60, but now it's flattening again. I don't know. Like it's kind of hard to predict what the yield curve is going to do. If we cut 75 basis points before the end of the year, it's possible that 10s will come down 75 basis points. Like that's possible. Like you could see mortgage rates get to 6. Like that could happen. I can tell you that the housing market kind of needs it, Getting mortgage rates from 7 to 6 would get a lot of people off the sidelines.
That's what I was wondering next. I'm kind of wondering what this big rate drop means for buyers and refinancers. I think a lot of people always wonder if they should take the plunge on buying a house or if they should wait for potential cheaper borrowing, but there's always risk in that.
I have an opinion in that. First of all, because of all the demographic reasons that I've talked about before, we still have a housing shortage. We still have an increasing population. We still have a deficit of houses. I think housing prices are going to continue to go up. I think that waiting for them to come down is a bad idea. Look, if you buy a house with a 7% mortgage, you always have the option to refinance. If it goes down to 6%, you can refinance. If it goes down to 5%, you can refinance, right? But if you don't own a house, you're stuck, right? So I don't know. That's always been my philosophy.
The potential for a fiscal crisis in the UK. So the Wall Street Journal posted this: is the UK a canary in the coal mine for a heavily indebted world? Borrowing costs are surging for many industrialized countries, causing talk of a possible crisis. I saw you also tweeted this. Has anyone considered the possibility that the UK is headed for societal and financial collapse? Some of the reasons here is I understand the UK's borrowing costs keep rising. Its economy isn't growing as fast as hoped, and the government has struggled to cut ballooning welfare spending. Basically, economists worry the pattern could keep repeating. Now, I mean, not to say a crisis is imminent or inevitable, but you did mention societal and financial collapse. Can you give me your spark notes on your thinking here?
First of all, there's not going to be an election in the UK until 2027 at the earliest. So Labour is going to be running the show for another 2 years at a minimum. Keir Starmer is awful. He's the worst. And it's funny because, when he was elected last year, or I guess it was last year, I talked to some people in the UK and they assured me that he was a moderate, that he was safe hands. And the guy is a flippin' maniac. He's a flippin' maniac. When I was talking about societal collapse, I was really talking about the speech restrictions in the United States. The UK throws about 30 people in jail every day for online posts, right? It is madness. And apart from the fact that, violent crime is mostly going unpunished, right? But they're throwing people in jail for Facebook posts, right? It's that combined with the fiscal situation. By the way, one thing you didn't mention is that French yields are now above Italian yields. Italy used to have the highest yields in Europe for a long time. Now France does. The UK is very close. We're kind of getting, this is back to boomerang 2012, European debt crisis. Maybe it was 2011. I think it was 2011. It's it could be happening all over again. And I have no exposure to it, unfortunately.
One quick question in the mailbag from our last episode in response to our talk on gold and silver. This person wants to know, what about out of favor metals like platinum and palladium at these levels?
Yeah, I mean, platinum ripped, palladium ripped, and then they pulled back and they're consolidating. Super bullish on platinum and palladium. You just got to be careful. They're not as liquid. But yeah, I mean, the metals in this environment, they should all work, even the PGM metals.
And then we had a guy chime in on the Heinz ketchup versus Hunt's debate. He writes, Heinz ketchup is made with high fructose corn syrup. Hunt's is not. To which I say, no wonder Heinz ketchup is so much better. It's literally laced with crack dust. So I don't care. Give me my Heinz.
Give me that high fructose corn syrup.
Yeah, pump me with the high fructose. Looking at the week ahead, we've got August PPI on Wednesday and CPI on Thursday. There's also an Apple iPhone launch event today as we record on Tuesday, which I'm at least semi-interested in, considering I'm still rocking an iPhone 14. What about you? Anything else on your radar?
I'm thinking about getting the AirPods. I had some AirPods 5 years ago and I stopped using them, but I'm I want to get AirPods for the treadmill, right? Because I watch TV on the treadmill, like I watch Bloomberg, but I'm not, it's kind of wasted time. Like if I could make phone calls while I'm on the treadmill, like I would do that. And I've heard that this new generation of AirPods is supposed to be really, really good.
Yeah, so that I think they're releasing the 3s or something. I have
Yeah.
the AirPod 2s, and I also have an Apple TV, so they like sync perfectly. And I've started watching movies with the AirPods in because you can just really hear the dialogue so much better, and it's just kind of immersive. I love the AirPods. I use them every day. So I
Yeah.
highly recommend them. I think you should pick them up. That's all I got for this week. Thank you everyone for watching. Please like and subscribe. I am out of here to watch the rest of this Apple presentation. Later, Jared.
See ya.